Hello. Oh, hang on. Do I have no volume? No, we're not hearing you, Greg. Can hear me? Um, hello, hello. It's like a silent movie. Oh, there he goes. He's gone. He's going to try this again. Oh, hello. You can hear me? Well, we cannot hear you. I don't think you're muted. Let's see here. Oh, um, sorry, folks. We got a little technical difficulty going on here. We can see Greg.
Hello.
Oh,
Oh, hang on. Do I have no volume?
I know they can hear me because it just came through my phone on the recording. So, Greg, this is definitely on your side. It's a terrible, lonely feeling when you're looking around trying to figure out which buttons to push. I'm going to call Greg. Let's just see if we might be able to coach him through this. Hello. Oh. Hello. Oh, hello. Hello, Greg. Wow. You got no volume anywhere right now. What's going on here? Uh, you can't hear me? Oh. Okay, I'm going to end the stream. I don't want to do that because that'll restart the. Hello?
Hey, I can hear you now.
You can hear me on the restream?
No, I'm on my phone.
Yeah, exactly. But yeah, you're not coming through on the restream at all.
Yeah, no, I'm not hearing you at all.
Um,
You want to try and log it out of your end and log it back on?
I think that's going to create issues because that will. And I just checked on LinkedIn. The sound is coming through. My sound is coming through on LinkedIn.
Oh, really?
Yeah.
Huh. Look, send me a link again to get that link that we found together. Send me an updated link.
Yeah, I'll do it right now.
Log out on Friday.
Okay. Hello.
Okay, Mike, hang on.
Oh, there you go. I-
On my phone.
Oh, wait a minute. Yeah, that's the phone.
Let me
I haven't.
Mike.
What if we do this? It's kind of cheap.
Hear me now?
Oh yeah, there we go.
All right. I just shut my mic. I rebooted the microphone for the third time. So maybe the third time's the charm.
All right. Hey, Greg Kuda, welcome. Lumber
Yeah.
Futures from the free
Yeah.
seats. And it's free and you get what you pay for.
Yeah. There you go.
Hey, we a little late start. Let's jump right into it.
Yeah. Welcome. Thank you. So I just want to, and I had sent this out this morning. Today's November 1st. So just a reminder, there's no limits, obviously, in the spot month in either the legacy contract or the mini contract. With the legacy contract, as of today, either January or March, so it's either or, limit moves today are $24. So you have limit moves in all legacy months, but you could have a limit move up or down. It's only $24, and you would lock limit at $24. And so then that would trigger an expanded limit of $48, which is amazingly still $1 under our limits that we had yesterday. So that's the big change for the legacy contract. And then the other thing I want to remind everybody, the mini futures still have the circuit breaker where there's a maximum daily limit of 10%. So just as an example for today, Jan Legacy has a $24 limit up or down today. The mini contract has a $58 limit up or down today. So at some point, you're going to see a pretty good opportunity in the mini contract if we lock limit in the legacy contract, because you will have a significantly wider limit at any given day in the legacy. In the mini versus the legacy. So
and in addition, there are no longer any options being offered on the legacy contract.
Yeah,
All option
yes,
trading
yep.
is options on the new mini contract.
Yeah, so we're obviously trying to make markets there, and very slow going. So again, this is the CME's way of kind of gently pushing people into the reality of the new mini contract. That there's no churning back. The legacy is going to be phased out, and so these are the little things that the CME can do to kind of push.
And so I'll just point out the legacy the mini November contract traded 610.
Yep.
While the legacy is offered at call it 460.
Yeah,
$150.
Yeah, and so if you want to say that spread should be $105-$100, how does a sawmill not come in and just capture that's free money and just deliver the wood? Like it's truly amazing that our industry is this stubborn, where that's just free money if you can deliver the wood.
Well, and I'm going to sit here and say the heck with the sawmills. If you are an industrious person, and
no, absolutely.
Consider figuring out a way that you can make delivery on that in November new contract. And I mean, if you buy a rail car with the futures contract that's going to ship into Chicago, I mean, I don't want to see a delivery made. I think we should trade out of it, but there should be like $40 a thousand to $50 a thousand sitting on the table.
Yeah, no, absolutely, absolutely. So, um, what else? Oh, and then the other thing I wanted to add, and I didn't put this in this slide, we petitioned the CME, officially petitioned the CME today with the actual limits being reduced today to lower both legacy and mini futures margins. So we'll wait to hear back on that. They'll at least we'll look at it. Jump into
You gotta
kind of
share your
the.
screen for us here.
Oh yeah, I'm sorry. Let me share. Let's see here. Share screen. Oh, you know what? I'm sorry. I didn't realize I didn't have the. So I'm going to go back to the one slide here. So again, new limits today are $24 with expanded limits of $48. The mini contract still has a 10% max limit. So again, if you look at today, Jan Legacy has a $24 limit. Mini has a $58 limit. And so, you know, like again, just using January as an example, limit down today in September or in Legacy January is $430. Limit down in the mini is $528. So again, you've got a pretty significant change if we were to go limit down. So you can kind of visually see this. And let's jump forward now. So big picture, interest rates are kind of holding steady in anticipation of tomorrow's FOMC meeting. I think the expectation is a half to 3/4 of a basis point. More importantly, it's going to be what does Jay Powell say afterwards. And you know, the one thing that stands out here over the last week is you've had a pretty significant rally in both the Dow and the S&P. Where we talked about this last week, and you've had a continuation of this rally. Rallying along with it is crude oil. Crude oil is just under $90 today. So I think some of the expectations is that I'm reading, you know, how engaged will he be as far as supporting any type of Christmas type rally in equities? Or does he just quash that and just try to, you know, annihilate this current rally with what he has to say tomorrow? So we had talked about this buy signal that was generated in equities. This is as of last week, and you can see this is kind of like a 60, 50, 62% rate objective to the upside in the S&P. And you've had a 50, you know, we've gotten up to the 39.30 area in the S&P. So you've had a pretty substantial rally off of this low where it generated the buy signal. And so we've gotten up to 39.20, 39.30 twice, and we've kind of, you know, gotten pushed, repelled here. So the big thing that you'd want to see now, if you're still long equities and you get this move up into 40, 20, 20, 40, 22 in the mini, would be a close, this black line, green line, or the 100-day. So a close above today's highs, the recent highs of 39.30, let's call it, really opens up another handle to the upside in the S&P. So I think this is all going to be predicated on what Jay's, you know, what the Fed says tomorrow, what they do tomorrow.
And like I've said before, the stock market is a forward-looking, predicting where the industry, where business will go and the economy will be going. It's kind of saying they've baked in the bad news and are looking past it right now.
Yeah, and you know, I think that's yeah, I'm not sure if I'm on board with that, but you know, markets, even in a bear market structure, you can get pretty large bear market rallies, and equities are in the middle of one. We just ended Q3 yesterday, so here are Q3 returns. Dow is still down 9.92% for the year. S&P is down just under 19%. You can see gold is still down 10%. Crude oil is still up 15%. But this gives a good analysis of kind of what's going on here year to date with the end of Q3. And I think, you know, when you look at the rally that took place in October, I think it was the largest rally in the Dow since 1976. It was the best month since 1976. I think a lot of money that was sitting on the sidelines had to be allocated. And that's a big reason why you saw equities rally the way that they did in October. So we'll see what kind of follow through exists now, especially with treasuries yielding 4.5% to 6%, depending on the duration. Let me see here. So kind of the other thing, we've had this bounce in WTI crude. We've had a bounce in wheat and soybeans. And part of that is with wheat kind of rallied close to 60 cents here off of Russia backing out of a wheat deal because of what's going on in the Ukraine. So you've had nice appreciation in soybeans, corn, wheat over the last day and a half, and you've had pretty decent appreciation in crude oil here. Crude's up $2. It was up $3. So again, looking for these signs that inflation is under check, kept in check here, going to be reined in. I think a lot of this has to do with the dollar. And let me just fast forward. Here's a dollar. The dollar's kind of bottomed, kind of almost a double bottom here, where if you see this coil formation, to me, this is a bull coil formation where you could have another breakout here right above this 111 to 111.5 area. And if you were to break above $1.11, then that portends maybe you retest the recent highs or go back up to 114, 115. And again, that strong dollar policy, let me come back to these, but again, we've talked about this, that we're exporting our inflation to everywhere else, and Europe, Great Britain, England had their inflation read numbers yesterday, and the headline was Eurozone inflation hits a record high of 10.7%. So even though their growth is decelerating rapidly here, they're still dealing with an acceleration of inflation. So again, the byproduct of strong dollar is we're exporting our inflation everywhere else, and unfortunately Europe is struggling more so than we are. So here's commodities. These are the Q3 winners for commodities. You can see orange juice up here. Gasoline is up, just under 1%. So we'll live with that. Here's your wheat. And this wheat, a lot of this is baked in the last day and a half, 2 days here from the news with Russia over the weekend. Same thing with corn. And then the losers, and just so people are aware, the losers list is a lot bigger than the winners list. And unfortunately, here's our market down here. So for the quarter, lumber was down another just under 22%. And strong U.S. dollar, you see the impact on foreign currencies, euro, Swiss, Canadian dollar, British pound. Here's the S&P, down 6.7% for the quarter. Even hard assets, inflationary assets like gold, still down.
Sorry, I accidentally removed you. Yeah, reshare that. I thought I was going to remove your name and let them see the.
There we go. So again, that strong dollar, is truly impacting a lot of these markets here. And unfortunately, lumber is still toward the bottom of this list. So 10-year Treasury is still hanging above 4%. Look at the interest rates on a weekly basis. These have kind of moderated the fixed FHA, fixed VA loans, but that 30-year, again, $300,000 house, 20% down payment, kind of below average credit to average credit. This is starting to still creep up. This I think a week ago was 7.4%. So there's no reprieve in 30-year mortgage rates. And so we just talked about the fact that we have our FOMC. What's the Fed going to do? Of interest, Goldman Sachs finally raised their forecast along with everybody else. And so we've talked about how, the initially to get Fed funds rate to 3.25%, but you look at the long-term forecast. This is a Bloomberg economist forecast along with Goldman Sachs, you can see as you get into January of next year, you're still forecasting a pretty significant move above 3%. By Q1 of next year, terminal Fed funds rate is still, collectively somewhere in this 4.75 to 5%. So if we're at 3.25 right now, this month, next month, into the beginning of next year, the reality is you still need to go another 1.5 to 2 points higher to get into that terminal forecast Fed funds rate. So, the idea that the Fed's going to slow down, I as much as I want to believe that, I think they, again, need to see the data, and the data doesn't suggest from an inflationary standpoint and from a labor standpoint that there's a reason to slow down right now. And so we talked about Euro. The other thing that I saw on Bloomberg that I thought, this was yesterday, more than a third of U.S. small businesses couldn't pay all their rent in October.
Wow.
Yeah, that's kind of scary. And then when you look at, 10, so more than half say their rent is at least 10% higher than it was 6 months ago, and say 7 say, I'm not sure what if this 1 in 7. I'm sure that's a typo. And in 1 in 7 maybe say rents are 20%. So I think where I'm going with this, so labor productivity plummets. So look at this labor productivity. You haven't had this metric since 1981, since the 70s. You're going back to some areas we haven't seen in a long time. So I guess where I'm going with this from a labor standpoint, part of what the Fed wants is obviously asset deflation, but then the other part of this is they want to start to see unemployment creep up. I mean, I think that's the byproduct of what they're doing here, where they actually want to see unemployment start to move higher here.
I'm curious as to how they would measure that productivity, but when I'm looking at that chart, it's 10 years is just one of the points. It takes 10 years to move between the points along the bottom axis.
Yeah.
Doesn't bode well for the work from home.
No, and I think it's just when you have your input cost and labor being one of them, and you're paying higher wages, you're paying higher input costs, and whatever widgets you're producing, what's your overall profitability? I think that has a lot to do with how, and that's a great question. I'd love to see what the metrics are that they use to calculate this, but it certainly doesn't bode well from a profitability standpoint in that, unless there's some big reprieve in your input costs, the last thing that's going to get bled out of your productivity is going to be your wages. Wages, you're not going to, give people these inflationary increases and then pull those back. You need to see the reprieve in the form of inflation with goods. That, the good inputs need to see those reductions in inflationary type numbers. And then there's another, I'll come back to, here's jobs change in the U.S. Since March of 2020. So you can see, kind of the winners here. And I think a lot of this, interestingly, would probably have to do with taxes. As far as I would love to see what property taxes, income taxes look like in a lot of these states that are green, that have seen positive growth, versus some of the states that have seen the bleed out. But when you look, I'll come back to that. But when you look at again, input cost, we know when it comes from a housing standpoint that lumber has seen a significant, lumber's off 46%, framing steel is off 13%, decking is down 23%. But when you look at some of these other inputs that go into building a house, you're really not seeing signs of a big pullback here. So when you look at these goods, these input costs, whether it's building a house or kind of whatever you're building in a factory, have you seen the benefit of a pullback or signs that inflation is abating? And I think that's what the Fed's looking for, to pivot it all from their current state of what they're trying to do here.
Yeah, I mean, it's the numbers have to show the Fed something is working.
Yeah, and I'm, as much as I want to believe, what lies ahead is going to be more beneficial. I think they again need to see those consecutive monthly numbers, actual numbers that prove what they're doing is working. Before they really pivot on their interest rate policy.
All right, let's take a look at. You're going to look at some oil, and then let's get into.
We'll jump into housing pretty quickly. I don't have that much with housing. But who's buying Russian oil? I thought this was interesting. So this is start of the war right here, and you can see that companies like Western Europe have kind of moved away, with the exception of Italy, exception of Turkey, the Netherlands. Obviously India, China have taken a much bigger piece of the pie now. Where again, this is Russia's only real form of income. So you can see that, obviously India, China are the beneficiaries here, but for all the tough talk, countries like Italy, the Netherlands really haven't deviated all that much from their pre-war policy of consuming Russian oil. So we'll jump to housing. Housing and GDP. This is, again, from Leonard Kiefer. 6 consecutive quarters of negative contributions to GDP with housing. So residential investment is a negative drag on GDP for 6 consecutive quarters, and likely it'll continue to be that way for consecutive quarters to come. I know kind of negative with housing, but let's not compare the current state of affairs to the cratering that we saw in 2007, 2010. So here's supply of homes on the market. You're nowhere near where you were. There's still a massive undersupply of homes today that exist, especially versus the last housing recession in 2007 through 2009. So this is a positive. Again,
what's oversupplied right now are the dollars. There's too many dollars in the system.
Yeah. So this bodes well, especially for the multifamily segment. Lending, there's no issues with subprime or poor lending practices. We're pretty moderate there, so that's a positive. Again, you just have to be able to afford higher interest rates, which is easier said than done. And then I think there was one more. I didn't put it in here, but so jumping into lumber now. We tried to have that, this is a weekly continuation. We tried to have that breakout above this channel, short-lived, and now we're kind of slumping back. It'll be interesting to see, do we fall back into this downward sloping channel on a weekly continuation basis? And then this is another weekly, same thing. We had this attempted breakout of this coil formation here, kind of failed. This is a 9-week moving average, the Bollinger Band here. I'm sorry, this is a 20-week, kind of failed into these moving averages, and now we're slumping back off. And so when you look at this on a daily basis, November today, the low is 57.40. You officially retraced 62% on a November daily chart. Ideally, you would hold somewhere in this area. If not, then the next big obvious support area is going to be back into this gap area, into the Bollinger Band low. So back into the mid 40s, back into the mid 30s. That's kind of the next downside objective if we don't hold here. And then when you look at January's through 62%. You filled the gap here. This is a 451 gap close. The low today is 449. So really, the next big band of support is going to be the Bollinger Band low in January, which puts you into this low 430, 429 area. And until something changes, it's just kind of, we had this brief reprieve, and now we're just kind of back into this downtrending type pattern on the daily charts right now.
Yeah, it looks to me like we're kind of sideways to lower until someone decides, or until the industry decides to build an inventory.
Yeah.
And
Yeah.
right now, we may not be in liquidation mode, but we're definitely not in build mode for sure.
No, and I think that's the difficulty is that I think people will step up and buy when they need to buy something. But as far as that accumulation phase, I'd like to say we're seeing it in futures, but really you're not with the continued decline in open interest. So, what's the incentive to accumulate? And I think that's the problem right now. I don't think people see necessarily the incentive. Yeah, I like these numbers, but until there's a reason to accumulate, I think you're just stuck in this status quo of buy what I need and go away. Get
And
1 to 2 weeks and go away.
it's prevalent through the entire supply chain. Like I, in speaking with some retail yards that cater to the multifamily and even some turnkey framers, they're not getting the confirmed orders from the general contractors and the developers yet.
Yeah.
The jobs are going to go. They know they're going to happen. They're just not giving them the business yet.
Yeah. Yeah. And unfortunately, that's not a surprise. So here's NovJan. I guess the question I have out there for you, Mike, and everybody else, does Nov deserve to be at a premium to January under this current structure? Or is this the result of month-end liquidation by the commodity funds, the last hurrah of moving November into January? But if history is going to play out here historically, seasonally, then really this NovJam belongs 10 to 15 under. And I think, under the current state of where cash is, where November is, you're probably going to have to see this spread go negative, or November go to a more severe discount to physical cash to attract any type of new buying.
Well, there's an old saying, near is dear. And
Yeah.
it means, well, it is indicative of a market that there is not a high level of inventory. Near meaning the nearest month and the closest for me to purchase. Dear meaning special, that it's a premium. So what I read there is, look, I'm not going to buy wood for January today, but I still need some. I'm in business to sell wood or to consume wood. I'll buy what I need. I'll buy what I need, but I'm not stepping out.
Yeah.
So that's in a condition like that, the front month runs a premium.
Yeah. So we'll see how this changes in the next week. Here's Jan, March. Again, the further out you go, here's your negative structure where you're basically 8 to 10 under right now, which kind of makes more sense for this current market structure. And again, historically speaking, this should be somewhere in that negative, probably 15-ish type area, negative 15 to 20, ultimately. And then from a curve standpoint, here's that premium in November, and then you get the discount in January, and then you stair step up into March, stair step into May. So if I look at this, obviously, if I'm buying November, it's to take to EFP or take delivery, but the real value probably lies in January and or March, depending on the time frame. And with this cost of carry in November, I'm more than happy to buy either or at this point. I'd be fine. This is where you're going to build out. And again, you don't want to have the cash outlay to build out your physical inventory. I get that. But look at the mini futures, look at the legacy futures, just look at futures as a way to own inventory without that cash outlay.
This shows me the fear index is pretty low. People are not afraid of the market.
Yeah, and you see it again. We know that this kind of premium here in November to March is more illiquidity, but you can see again to own this curve, and the liquidity is picking up in Jan and March, but between $5.80, $20 between January to May, you can buy all these months. If you want to own for physical spring needs, it's okay to buy in a scaled down fashion these back months and take advantage of these numbers without having that 100% cash outlay and the cost to carry associated with physical cash.
Sure. I mean, look at the cost to carry from Jan to Sep right now. The spread there, let's call it $40 a thousand. It's just under 10%.
Yeah.
So when you factor in interest, storage charges, it's actually cheaper to buy the extended months than to buy the cash and put it on the ground right now.
Yeah, no, I think that's spot on. And then when we look at basis, a week ago, we had talked about how cash was still, you still had that bigger differential between cash and futures. And then, we've basically collapsed in now where cash is actually at a premium to futures. So a week ago, just the opposite. Cash was at a discount to futures. We've given it up in futures now where futures are at a slight discount to physical cash. January, again, a slight discount. Again, this is where if I'm going to buy anything, I'm buying January at a discount to physical cash.
100%.
That's kind of how you interpret this basis. Same thing in March. I can buy March at a discount to physical cash. So this is a no-brainer, and this is why, we keep sliding lower. But the thing that I get echoed to me, well, I don't want to sell the board down here, but I'm not sure if I want to buy it. So, and you see this reflected in open interest. So open interest as of yesterday, 1980 down 55. We broke down under 2000. So we're off since the high water mark, just under 3,100. Open interest is now down 36%, which is obviously discouraging, especially this time of the year where we seasonally bottom. This is where you would ideally like to see a build in open interest, not a decline. And so when we look at the CFTC numbers, the obvious answer, the managed money component, the short component, the short funds liquidated another 372. This is as of last Tuesday. So commodity fund shorts liquidated 52% of their overall position. The other thing that glaringly jumps out at me here is this managed money, the long position increased dramatically. So this is a pretty big swing between these two. And then when you look at the commercial, the producer side, after seeing lumber drop 75% since the highs in February, somehow commercials decided they want to short the market now. And then with the rally we've had, those premiums, the basis opportunity in November and in futures trading at those premiums to cash, well, you obviously had people take advantage of that, liquidate their futures at a profit at a premium to cash and go buy the physical cash. So
Yep,
this
and
makes sense.
There was basis opportunity there.
Yeah, absolutely.
So
absolutely.
It's the right thing to do. Buy what's cheap, sell what's expensive.
Yeah, and I can't stress this enough. I had sent something out earlier this week that basis is your best friend, and understanding the correlation, the basis in your species that you trade, whether it's correlation to other species or futures or all of the above, you get to take advantage of there are great opportunities. And if you can capture 80-85% of these basis opportunities, you're doing better than most. I mean, that this is just, it at least tells you, where you should be buying, where you should be selling, and understanding those basis charts. The other thing I wanted to point out, I know that there's confusion still as far as, are we going to get a U.S. rail strike? Where at least I want to say at least 3 of the unions still don't agree with what was arbitrated. The earliest that the U.S. railroads could strike would be November 19th. So obviously we've turned the page into November, but I thought this was interesting. This is rail traffic, versus the last 2 years. So, the question I have here is this, because the economy is slowing down so much, there's just less rail traffic moving across the pipelines here, across rails, or is this kind of an anticipation of an impending rail strike? I don't know. Probably both, but is this a sign of poor economic activity? And that's a strong possibility.
There's no fear in the market for it. I mean, January, if there was some fear about a rail strike, January is not reflecting it.
Yeah. And then from a leg, this is the mini volume, kind of, again, frustratingly low. But again, the hope is that we gradually start to see this build going into the end of the year, Q1. And then, again, this is the insanity of not taking advantage of the differential. Here's your legacy Nove Jan spread. It's currently 770 last. This Nove Jan spread traded 30 over. So, I mean, that's $23 differential where, how does, if the mills don't want to use this, then, that this is, again, I'm not going to say it's free money, but it's extra money out there, floating out there to take advantage of.
Get creative.
Yeah. Yep. And then the last thing I have, Mike, is NALA is next week in Phoenix. So do we get the post NALA? Typically NALA is associated with obviously good times, but people come out of NALA with a positive outlook, and we get some kind of rally in physical cash thereafter. Does that potentially exist? Maybe we bottom out into NALA next week, and then kind of follow the more traditional seasonal patterns into the end of the year. And then lastly, I'll be there next week. So if anybody's going to be there and is interested in meeting up, please reach out.
Excellent. Well, I'm kind of recapping, what we went through. It just, I go back to there's no fear. There's no desire to really take advantage of opportunities in the market right now. It's just lackluster. It almost feels like maybe a calm before the storm. I know that there's business out there, and it's not the time to get lulled to sleep. Let me put it to you that way.
Yeah, and all I'll say is, to reiterate, basis is your friend. Understand what you should be buying, what you should be selling, where value lies. But the other thing I'll point out with this declining open interest structure is that momentum is not your friend right now. In a declining open interest structure, chasing momentum is a recipe for getting whipsawed, where the only way that this is going to change and you're going to support a breakout, especially a breakout to the upside, is to see a build in open interest. So for this market to ultimately bottom out and begin to stair step higher, this is what I'm watching, pure and simple. I want to see this build in open interest, either legacy or mini or a combination of the two. But a declining open interest structure just continues to be a market structure where you just look for people to stop out, and when you run out of people to stop out, the momentum stalls and you go hard the other direction. So I think this is critical. Look for that build in open interest as a sign you're truly bottoming and you're going to move higher.
And I'm watching the managed money. They've been really patient. I wasn't surprised at how slowly they've taken their short position off. And now they're starting to build that long position. What that tells me is if we go lower from here, what they will do is flip their position, continually cover those shorts and add to their longs.
Yeah. And again, I think that would be a good change. And again, seeing is believing. We need to see that build in open interest.
So be patient, be vigilant, and be here next Tuesday.
Yeah, I appreciate it. Thank you so much.
Look at the
the
next. You have some great comments. Wow. Who would have thought lumber was that exciting? All right, everybody, take care. Appreciate you coming to watch. And Greg, hang on. I'm going to check.
All right.